Shane, welcome to the new year. How are you doing?
I'm good, man. Happy 2024. I can't believe it's already like the end of January and we got the first month in the book. Feels like it just started like 5 seconds ago. And I don't know, man, the older you get, the faster the time goes, I guess. That's the way it seems for sure.
Yeah, and it's interesting. Usually when we flip into January, I'm always looking for a big change in market direction, and it does not look that way. So we are just hitting new all-time highs, and we'll get into it, but some stocks are certainly not hitting new all-time highs, and what does that all mean? We'll see.
Yeah, I mean, we had a nice little pullback as soon as the new year came through. I think that's normal. You get a little bit of people who just want to take some profits now that we're in a new year and have the taxes not be due until, 2025. So definitely look like as soon as the new year flipped over, we got some of those sellers. Market started the year down 2% and since then has risen 4%. So I guess that means we're up about 2% overall for the year so far, at least on the S&P 500 side. Um, but yeah, not much of a change in direction, just a little hiccup.
Yep. So, well, we can go ahead and jump into the chart deck here. I know
Unless,
we
of course, you're looking at the Russell, which, did a total about face, by the way. Russell is down 3.6% for the year and still down over 20% from its 2021 highs. So, the 2000 stocks of the Russell are not doing very well.
Yeah, and so here's the S&P where we're at right now, and I one thing that comes to mind here is an object in motion remains in motion, and typically that's what you see just overall market. We continue higher like this usually leads to a positive year, but history oftentimes rhymes but may not repeat. So yeah, any other context on this?
I mean, the S&P 500 equal weight is also was down 3%, now down about 1%. So the equal weight isn't doing very well either. Yeah, I'm surprised you started off with the slide that is on the screen for people who are watching on YouTube. It shows the S&P 500 after some extreme events and what happens after those extreme events. And the extreme event in question is after a 10% gain during the months of November and December. So if you take the 2 months of November and December, put them together, how many times in history has the S&P 500 been up 10% or more? And then what happens in the 3 months, 6 months, and 1 year after those extremes? Most people would say, "Oh, it's up 10% in 2 months. That's pretty rare." Uh, Probably, you want to buy low and sell high. So we would sell at that point because, of course, the 10% gain in 2 months is pretty good. That's more than the annualized gain. So for a whole year, the market doesn't always go up 10% on average. So you would think that after a 10% gain in 2 months, the returns would suffer. And I mean, I think that's like common wisdom. If you go ask 10 of your friends, 10 people who have invested in markets, say like, hey, the market was up 10% over the past 2 months. What do? Buy or sell? I'll bet you the majority of people say sell.
I would agree.
I mean, that's probably what I would say. When you look at the data, however, um, it says something totally different. It says in the 3 months after that extreme, a 10% gain in November, December, 3 months later, the market was 6.5% higher. And if you just look at all periods, so every single year, right, regardless of what the market did in November or December, the first 3 months of the year, the market's up on average 2.2%. So 6.5% versus 2.2%. You would actually do better if you bought after those extremes. And after 6 months after the extreme, the market is up on average 12.8% versus all periods market only up 4.5%. And then if you look in the 12 months after the extreme, again, the extreme is a 10% gain in the final 2 months of the year. 12 months later or 1 year later, the market is up 19.4% on average versus only 9.1% in the all periods each year since 1950. So buying after the extreme actually leads to outperformance, which is totally counterintuitive. I don't think anybody would guess that that's true, but the numbers, uh, the numbers don't lie. So, um, I'm going to write a little bit about that in the upcoming commentary, which is where I think you got this information from. And yeah, it's just interesting to think about.
It is. And then
Have you ever seen anything like that before? Like, do you ever look at those kinds of data points when you're studying markets and trying to determine how to position? Do you ever look at stuff like that?
I used to read more about it. So, whenever I would have access to research, Craig Johnson over at Piper Jaffray would kind of put this huge chart book together and he would break all that down. And it does seem to prove out that when you have a positive year does follow. So, not really too surprised by those numbers. And now we have an election year, so that has its own dynamic as well. So,
What do you
I
think about the nature of data versus philosophy?
I think that data, I mean, that's the big one to look at there. You should be able to go back and kind of prove out a point or see if something does, test out. So is it statistically significant? And
Yeah.
that's the key thing right there, I think.
I
You
think
know,
one of the well, and I mean, no matter what you're doing, even going back to 1950, I question, how many data points are there really to look at in there? I mean, how many times was the market up, 10% in November and December going back 75 years? I mean, was it
yep.
was it even 10% of the time? Probably not.
And other
Um,
factors that really play in is what was the preceding trend. So, for instance, the Great Depression, 1930, right around there, if you look at the following years, you might say, wow, you get these huge gains after those positive years, but yeah, that was coming off of a 50% drawdown.
yeah, yeah,
So,
interesting.
and now looking under the hood, we've heard a lot about the Magnificent Seven, and we'll get into that. But right now, in terms of the sectors, the big thing I just wanted to point out, I often talk about this heat map, but you've got financials 99% above their 200 day, and then you've got, tech 91%. And the things I'm kind of looking for there is, are investors getting into offensive sectors or defensive sectors? And you look over at consumer staples, just getting beat up. And then energy, I think energy does look like it is coming off a bottom a little bit. So don't want to read into that too much. But then utilities, 10% above their 200 day. I mean, that is just a terrible sector right now and historically a defensive one. So kind of tells me that people want to put money at risk right now.
Of course they do. Why wouldn't they? Fed's gonna cut rates, man. It's gonna be
Yeah,
everything is gonna be sunshine and lollipops for the end for till the end of time.
yep. And that's where it's so interesting is that you look at the technical picture and it's showing you this, the fundamental picture. We've talked about it, quite a bit now, and it looks terrible. So yeah, you can still invest, follow these trends, but you definitely want to be watching what you're in and where you're going to get out, if things turn.
Yeah, the energy space is pretty cool, man. I mean, I've been watching it. We've been in energy, long energy in our strategies for a long time, and I mean, we've changed the exposure, up and down and all that, but we've maintained our long position for a while. And going back to like March of last year when we put in a low, the XLE put in a low around like $75. There's just kind of an upward sloping trend line of higher lows that just got tagged, on January 18th, it looks like, right around $79. So kind of does look like it wants to bounce from there, and all the other major moving averages, the 50 and the 200 day, are actually quite close to one another. So maybe we can get a breakout going here in the energy space, which would be good for a lot of energy investors. So I'm just looking at Chevron and Exxon, some of these other stock, they just look terrible lately. So
Yeah.
um,
And I've noticed just looking at crude oil right now, you know, WTI crude is trading right around 76, and it looks like it's trying to break out of a base. You've got some unrest in the Middle East, and the big one too is just seasonally. This is typically more of a bullish time of year for that. So I think if energy starts pushing higher or oil, that's
Yep.
definitely going to help out the sector.
Yeah, I mean, actually, I heard the government actually bought some oil for the strategic reserve for the first time maybe last week or so. So I still think there is a bit of a floor under oil, because if it goes under 70, they claim that they're going to buy oil for the strategic reserve to replace all the stuff that they released, a couple years ago to try and combat inflation.
Hmm.
And there's nothing left. Like there's nothing left to do that with anymore. So they need to replace it if they want to be able to kind of tamp down any other oil price shocks that could come in the future. It's kind of like the same thing with interest rates. If rates are zero, you can't cut them,
Right.
to stimulate the economy. And if you don't have any oil in the strategic reserve, you can't release any um, to kind of put a lid on prices. So yeah, it looks to me like oil's going higher from here, which isn't going to help the inflation numbers, isn't going to give give the Fed any good reasons to cut rates if oil keeps going higher, because it's been a bit of a drag since what, I guess, since September.
Yep.
Oil hit a high of like 95 and then traded below 70 for a minute. So, yep.
Yeah, it hasn't been so positive. So, and now, flipping to, I guess, the Magnificent Seven, Shane. So you put up the market cap of Apple and Microsoft. They've just been neck and neck for the largest companies out there. I don't know. Did you check today to see which one's ahead?
It's the magnificently manipulated seven. It's the MM7 is what we'll call them, or six now, right? Because when one doesn't perform well, you got to kick it out, right? That's how the indexes stay going higher. Is every time there's one that doesn't perform well, they boot it out of the Dow, or they boot it out of the Mag 7.
Yeah.
But yeah, look at that. First time that Microsoft has had a higher market cap than Apple since 2021. So now the largest company in the world by market cap. And it actually, Microsoft is now over 3 trillion as of like intraday yesterday. I'm not sure what it's doing today. What's Microsoft doing today? Microsoft is up a little bit. So yeah, over 3 trillion of market cap for Microsoft for the first time ever. So trillion with a T. Can't the human brain can't even comprehend how many dollars that is.
No, that is
Just crazy.
a lot of money, and it just really makes you wonder, can it go much higher? If you're looking at the market cap, you might think, well, it's got to be overvalued soon, right? But you can definitely push that prices to extremes and watch it all come back. So who knows? But interesting to watch. Uh, so Shane, do you know which one of the Magnificent Seven might be on deck to get booted?
Yeah, the one that I keep shorting. Yep.
And that's so we've got the chart of Tesla up, and I this is the most god awful chart ever. There's you do not
Unless you like shorting stocks, then it's a beautiful
oh
chart, man.
oh yeah, it's great. And the options, they're very liquid, so you can use that. You can short shares. I mean, all kinds of options. But this is a classic example of what happens when a stock loses moving averages. It's in a downtrend, and you have a catalyst like earnings. Yeah, I went on Twitter and there's plenty of optimism out there that this is the great buying point. We're going to break out of this wedge. And I think, oddly enough, you have a line right here at the top at 410 about, and FinTwit I know is all about it. We're going to 410. That's the measured move, and yeah, it's trading at 181 right now. I'm pretty sure it's actually below that today.
For
Uh,
yeah, well, yeah, not it's pretty close to that. I mean, it might be falling further as we're talking, but I just made that chart. Yeah, 181.81 is where it's at right now. Dropped to the low today was 180.06. So I don't I'm not real good at math or anything. Um, but 410 to 180 seems like over a 50% drop from the highs. Right? If 200 is half of 400, well, we went from higher than 400 to now well below 200. So that's over 50% off the highs. even though the stock was up 100% last year. That's crazy and
Yeah,
stupid. Um, but
something
whatever.
else. And it's what's funny is now you want to talk about, well, let's, catch the bottom. Bad earnings report, what a great value. I wouldn't be the least bit surprised that we finish the year with this thing hitting 108 at least once.
Yeah, I
And
think it's worth $80. I mean, the last time I dug into like some financials on it and did a fundamental valuation, like it's a company. They sell stuff. Mostly what they sell is stock, not cars. But
yep.
that's a whole
And
that's a whole nother conversation.
yeah, Shane, it sounds like your mic's cutting out just a little bit.
Yeah, I don't know if I can do
There we
much
go.
about it. I'm not the tech guru. But yeah, I don't know, man. I mean, Tesla, I think it's no longer the biggest producer of electric vehicles in the world. That got overtaken by BYD out of China. And Tesla came out on the earnings call last night and said that their volume growth is going to slow even more. So they're going to produce, more cars than last year, but not as many more as they did than the year before. So their growth is slowing. They've cut their prices, which is eating into margins. They're not making as much money. Like you have to tell yourself a story about the future of this stock, about AI, about robotics, about data, and you have to sell yourself a story. You got to really believe in the story here because the fundamentals lead you to a price, probably sub $100, and the stock's still trading at 181. So, I mean, there could be easily 50% of downside left in the stock before it was uh, arguably fairly valued. It wouldn't even be cheap then; it'd just be fairly valued.
Right.
Um, I mean, that's just one guy's opinion, right? But just using some standard fundamental valuation models. And then, of course, when you look at technicals, I mean, the technicals look awful too. So there's not a good technical reason to buy this thing. I mean, maybe for a short-term oversold bounce, right? But
Yeah.
that's usually a bounce to a new lower high, and the trend line that we've drawn from 410 down to, the recent high at about 260 still holds. Until that breaks. It's just in a long-term downtrend. So,
Agreed. I mean, it's just you could trade short-term bounces, and that's the thing is a trade. Right now, I would not touch this as an investment.
I mean, dude, it went from 410 to 108. That's
Yeah, that's huge.
what's that, like a 75% drop. And so, yeah, it went up 100% in 2023, but it never even got back to 300, let alone 410. So, yeah, it was up 100% last year. Whoop-de-doo, man. I mean, you look at a bigger term or a bigger picture, and this thing is just in a long-term downtrend since, October, November of 2021. And I mean, I don't invest our clients' money in this thing. Some of our clients, want to own it and they bought it on their own, and we do our best to help them express their opinion without getting killed. But I'm not interested in putting this into any elevate strategies at the current price with the current kind of guidance.
Right. I agree. So, um, with that, why don't we turn it over? Just we are in earnings season, and that was the big catalyst for today, why Tesla's down so much. But now just looking at the sectors, Shane, where are we standing right now in terms of now this is the fundamental side. So these are the actual earnings reports coming out showing growth. And
Yeah.
here we have the S&P 500 in front of us. What are your highlights?
Yeah, well, before I jump into it, I just want to say that we're going to try and maybe release this as an audio only podcast. So for those of you who are listening and not watching, I apologize if I say look here or circle that or something along those lines. And you can't actually see it. If you want to see it, you can check out the YouTube version of this chat, and you'll have some visuals there to look at as well. But hopefully, releasing it as a podcast for audio only will get the word out to a few more people and maybe lead to some more interaction with you guys, some more questions that we can answer in an upcoming recording. So keep that in mind if you have anything you want us to discuss or any questions that you think we might be able to answer for you. Just shoot them our way. Info at Elevate Capital Advisors is probably the best place to do that. Um, but yeah, what we've got on the screen is an overview of the S&P 500 earnings so far. And what you can see is 111 out of 500 companies, so right around 20% of the companies have reported. This earnings season, the way that we've got it set up, started November 16th and will end around February 15th. So some of these reports are going back to December, I mean, even November of last year. But this is the season where companies report their fourth quarter, usually their fourth quarter, whether it's a fiscal calendar quarter or a quarter ending on, November 30th or something like that. But what jumps out to me is that with 20% of the companies reporting, we are seeing an average decline in earnings of 4.63%. So companies are on average making, almost 5% less in earnings than they were for this quarter 1 year ago. And sales growth is a measly 3.55%. Shocking how close that is to the inflation number. When prices go up by 3.5% and you make 3.5%, there's really not much organic growth. You're probably just getting most of it out of price increases. So it's better than a negative number, don't get me wrong, but sales are not growing very fast. Revenue, sales, whatever you want to call it, not growing very fast, and earnings are actually in decline. The big ugly ones are materials, where earnings have declined 24% and sales have declined 5%. And then you've got energy, which we were just talking about, where earnings are down 27% and revenue down 7%. So those are the worst ones out there. Let's see, technology doesn't look very good either, which we'll get to when we look at the Nasdaq. But technology is showing a decline in sales growth, or declining sales and declining earnings as well. So not good in the technology overall.
Mm.
So again, it just kind of shows you like the Russell 2000 is down for the year. The S&P 500 equal weight is down for the year. Earnings are down for the year. Yet the S&P 500 keeps making new all-time highs. So the market just doesn't care. They want to buy stocks, so they're buying stocks, and you either buy stocks with them or you kind of sit and watch on the sidelines.
Yep. And then, turn to the NASDAQ 100. So you mentioned that one, very tech heavy and some wider ranging numbers here, but kind of a mixed bag, I guess, on, up versus down.
Yeah, so with about 20% reporting, and when you say tech heavy, I always, wonder how, like, there's 43 out of 100 companies in the NASDAQ 100 that are in the technology sector. So about 40% of the NASDAQ is technology. It is not 100%, which a lot of people think, oh, I'm buying tech stocks. There's industrials and consumer staples and energy and even utilities in there. So it's when you buy you're not buying the technology sector when you buy the Nasdaq 100 or the QQQ. I mean it's 40% technology. Don't get me wrong. That's a healthy big, it's a heavy weighting compared to all the others, but it's not 100%. That said, with 20% of the companies in the I guess 18% reporting, we're showing an average earnings decline of 8.26%, despite the fact that revenue has grown by 5.33%. So they're selling more stuff, they're charging more money, but they're earning less, right? So earnings are in decline, and the worst sector is consumer discretionary, where earnings are down 39%. But to be fair, there's only one company reporting, so that's only one company. 6 out of 43 technology companies have reported an average earnings decline of 20%. So that's, again, pretty small sample size, but not off to a good start for the Nasdaq. The Nasdaq earnings season starts a little bit later. Like we haven't gotten Microsoft yet. That's like the 30th. Google, I think, is on the 30th. I think Amazon is coming soon. That's a discretionary, but it's in the Nasdaq. So Off to a slow start. They start a little bit later, and so I think next week is when we get most of these company earnings.
Yeah, so it'd be interesting to see what they're experiencing out there. And then,
Let's just
and,
hope it's not like the Russell, man. Holy moly.
yeah, and the Russell, a lot of small cap stocks, and this one pretty wide ranging on these earnings growth numbers as well as, well, I guess sales growth, man, a lot of red.
Dude, this is not like an earnings or sales recession. This is a depression. Uh, it's only 10% reporting, so maybe it'll change by the end of the season, right? We got 200 companies out of almost 2,000 companies reporting. But these 200 companies are reporting on average a 10% sales decline and a almost 40% decline in earnings. That's crazy.
Yeah, that's
Consumer
huge.
staples are down almost 50%. Earnings are down almost 50%. Real estate down 50%. Financials down 47%. So JP Morgan's doing great, but all the other banks getting smoked. JP Morgan's just taking all their business, you know?
Yeah,
Um, it's just pretty wild. And the technology companies in the Russell reporting a sales decline of 12% and an earnings decline of 40%. So this is horrible. Like it's really really bad. It's the worst. I don't know. I think I've maybe ever seen since I've been watching this stuff. And here's the kicker. Like not that it needs a kicker because these numbers are so bad. Like they should freak you out. You know, like that's not good. But get this. If I asked you, Kyle, and you pay attention, right? You're in markets, you trade. I mean, you're in this business. You're a professional. You've got letters after your name, all that kind of stuff. I'm gonna have you guess live on air. Um, I guess not live. It's recorded. We'll
a lot
post
of
it later.
pressure.
Yeah. How how many quarters, how many consecutive quarters has the Russell shown negative earnings growth or an earnings decline, if you want to say it that way? How many
And
consecutive quarters?
that is one statistic I've not kept up with on that. So, you know, I
It's
guess
more than one, I'll
I
tell
know
you
it,
that.
I figured more than one for sure. Um,
Yeah, all
but
right. Don't worry,
I
I won't make you guess. The I'll just tell you. This is the fifth, number five consecutive quarter. So that's a whole year plus another quarter worth of consistent declining revenue or sorry, earnings. Um, it's awful. Like it's it, it is really, really, really bad. And this, 2000 stocks, in my opinion, tells you a lot more about how the overall market of stocks is doing versus an S&P 500 where, 30% of the money is in the top seven.
right. Yeah, that's definitely a number I'd like to see go the other way. And what's interesting about this is technicals versus fundamentals. So here the fundamental picture does not look good. And if you look at the chart on these, I'm not going to say that's any better. It's been stuck in a range for, as long as I can remember. Looked like we tried to break out. We'll see if it continues, but yeah, it's just not very encouraging. And a lot of these companies also have bank debt, and that's going to get really expensive if we're in a recession and we have higher rates.
Yeah, and just to be clear, I mean the Russell 2000 index pretty much reflects this. It's still down 20% from its 2021 highs. Still down 20%. I mean, it's still in a bear market, period. There's no two ways about it. And every time we've gotten to sort of this 2000-ish level, you know, 3, 4 times in the past 2 years. And every time it happens, all the analysts are like, "Oh, it's gonna break out," and then it just fails and breaks back down again. So, I mean, eventually it'll go higher, and maybe this is the final quarter of declining earnings, because again, it's the fifth one in a row. And oh, by the way, it's the biggest decline out of those five. Like it's just been consistently getting worse and worse and worse for 5 consecutive quarters. So eventually, base effects will kick in, and things will start going the other way. But until that happens, I don't really see much of a reason to be buying the average Russell 2000 stock.
Yep, and I would agree with you on that
It's
one.
brutal bear market, man.
Yep. So, well, now flipping it over, talking about some fundamentals here. Fed policy. Yeah, we've got the Fed Beige Book up here. Shane, do you mind just kind of giving a highlight on what the Fed Beige Book is?
Yeah, I mean, again, for those of you watching on YouTube, you can see the chart. The picture is worth 1,000 words. But you can see that. I'll tell you for the people listening. Last quarter, the Beige Book, which was in, I guess, covered October. No, was it December? I don't know. It must have been November, I guess, that it came out. But it showed that overall economic activity had slowed. That was the first time we had seen a slowing economic activity since COVID, two back-to-back quarters where it contracted sharply. So this is the worst since COVID that we saw last quarter, and basically this quarter showed an unchanged level. So this is just overall economic activity and how that's looking. So if you want to check out the Fed's Beige Book, just Google Fed Beige Book and you can read all about it. I don't really tend to read through it. I just look at the overall assessment. And they say economic activity is kind of unchanged, and the prior report was that it had slowed. So this is why everybody thinks that the Fed's going to cut rates, is to prevent economic activity from slowing too much, thus leading to an economic recession.
Yeah, and
Which may have already started.
if I look at this, yeah, recently there was what is it, a quarter that was slowed economic activity, but then it kind of picked back up a little bit. So, I mean, I look at this and it's like, man, there's still a lot of way to go, right? We want to go to
Well,
slowed.
it hasn't picked up though. You see, like what that says is unchanged from the prior report. So it's just that it didn't get worse. The way that the chart is a little misleading in that way, is that it didn't slow further, right? So you don't get another orange dot on the slowed line. Like it's hard to explain so that people listening, wouldn't see it. But this is slowed, and this is unchanged. Unchanged from what? The prior one. So even
Got it.
though it's unchanged, the dot goes a little higher, which is kind of misleading. It didn't get better. It just didn't get worse. So, I mean, take that with a grain of salt. It just
Mhm.
didn't get worse.
Yeah, that's very helpful. And then, so we flip it over. Well, what didn't get worse? And I'm looking at this chart here. Capital One Financial, they have 30-day delinquency rate, and it's as high as I've seen it since what, 08, 09. And
Yep. Yep. The average delinquency rate on credit cards uh you know what? This says Capital One. I'm just looking at this. This says Capital One, and it's not Capital One. It is Discover. Uh
oh,
That was
interesting.
probably a brain fart on my part, because I love to look at Capital One credit card delinquency rates, because they have a slightly worse credit quality than Discover does. But both Discover and Capital One hang out at kind of the low end of the FICO score range. They do a lot more subprime lending than, say, an American Express, for example. So I like to look at those two versus something like American Express, and to see how much better American Express is. American Express probably has delinquency rates around 2%. But anyway, yeah, I'm just noticing that that's wrong. So what we're looking at, for those of you listening, is a chart of delinquency rates on Discover Financial Service credit cards. And they have spiked from a delinquency rate of under 1.5% when the government was printing stimulus money and sending it to everybody's mailboxes, and nobody had a problem, paying off their credit cards, to over almost 3.5% now. And the peak, back in the great financial crisis in 2008, 2009 was over 5%. So these are extremely high levels of credit card delinquencies that are more than 30 days late on making their payments now. And I'm here to tell you that none of the company's models for profitability work with delinquency rates at 3.5%. I mean, they're going to lose money. There's just
Right.
pretty much no way around it. Those need to come down. They need to come down fast, and I just don't see how that's going to be possible. So, even with credit card interest rates at over 20%, they're not going to make up for the number of people that simply are just not going to make their credit card payments at these levels. So that's a big spike in delinquencies, and I think we're seeing it. We'll get more data on this, I think, later this month, maybe early next month, from the New York Fed on delinquency rates for credit cards and automobiles and all those kinds of things. But the trend is higher, and it's no surprise with prices having done what they've done.
Yep. And that creates a recession. So we'll see where that goes. And then, Shane, this next chart we're looking at, I want to make sure I understand this correctly, but it's the monthly government new jobs as a percent of total new jobs. So if this number is increasing, that's telling us that, the hiring that is taking place is primarily in the government. Is that the correct interpretation?
Maybe not primarily, but it's just the share of government hiring is much higher than private payrolls, right? So the government is doing way more hiring than they normally do. And that arrow isn't just like an arrow I drew. That is the actual regression plot of, the government hiring over time. And it's usually a lot less. I mean, I can't remember what the number was, but if you go back, you know, a good long ways in the records, the government usually hires nowhere near 20% of the people who are hired in a given month. I mean, it's usually under 10% if I remember right.
Yeah.
So the fact that, in what's that? That would have been, so this would have been December, November, in October of 2023, out of the, let's say the jobs that were created was 200,000 jobs created, right? We get a jobs report every month. And if there were 200,000 jobs created, 110,000 of them were government jobs,
Yeah,
which
it's a
of
big
course
number.
they add nothing to productivity. The government doesn't produce any GDP or do anything. You know what I mean? Like, so all that hiring is just an expense for the taxpayer, right? It's not, they're not producing any goods or services. I mean, it's just, there's nothing happening there. They're not generating any revenue or creating any economic growth of any kind. It's just a drag. So, I shared this with one of my buddies, and he told me that, what do you say? For some of the tech people out there, but Alvin Toffler, the guy who wrote The Third Wave, um, Smil, Vaclav, Komsky, all agree on this one point: is that this chart is a increased government hiring as a percentage of overall hiring is a telltale sign of a country in permanent decline.
Yep. And I would
That's it.
agree with that one. It's what you want to see is investment in the infrastructure builds the economy, and that is done in the private sector, and they're
Yeah.
innovating,
Yeah, the
not,
government doesn't own cement trucks and construction companies, right? Like these are just, I don't know. I mean, don't get me wrong. If you work for the government and you are listening to or watching this, feel free to send us some feedback. I'm not trying to pick on you. I'm not trying to say your job is worthless. I'm just saying like it shows you that the underlying private economy that produces goods and services, produces goods and delivers services, is not growing as fast as a normal healthy economy should, and so the percentage of government hiring is higher, and it's just not a good thing for the economy overall. Doesn't mean that there aren't good people who work for the government, although I would argue that politicians are not good people.
and I would have to agree with that one. Although Nancy Pelosi is a phenomenal trader, and we should try
Yeah,
and get her on here. I know that she'd have some great stock tips.
I'd love to talk to Nancy about stock tips. That'd be great. Of course, I would end up in an orange jumpsuit, and she would end up laughing at me. But that's because the rules don't apply to them.
Yep. So, and then Shane, I think this next one is, all the rage in Bitcoin right now, and these ETFs coming out. Oddly enough, they came out, and now I think Bitcoin sold off a bit, but then you've certainly seen some of these companies selling off. I don't see it on here, but Coin's one where, that one got hit pretty hard.
Well, yeah.
So,
Why does anybody need to buy actual Bitcoin from Coinbase anymore? Now you can just buy the ETF from Fidelity or BlackRock or whatever. So, I don't really care to go through each and every one of these funds. It is an interesting environment right now where you see, well, many of you don't see it, but right now, several of these new Bitcoin funds are actually charging 0%. annual management fees. I mean, these are all legitimate zeros. So no management fee at all because they're trying to attract capital into their funds. Right now, the biggest one is Grayscale, which is $20 billion. Um, so I guess that's not in billions, that's in like millions, but they have $20.2 billion because they were a closed-end fund for a long time, and then turned it into an ETF, and they dropped the fee when they did that from 2% to 1.5% for anybody who's paying attention. But after that, out of the brand new ETFs that didn't have any money to start with, BlackRock now has 1.8 billion and Fidelity has 1.6 billion. BlackRock's current fee is 12 basis points, but it's going to go up to 25 basis points, I think, in 6 months. So they're offering a discount to get people to put their money in. And Fidelity, I think, is going to be closer to 45 basis points an annual fee. But right now, they're doing a deal where you don't have to pay anything. It's zero management fee. So all of these that say 0% management fee are eventually going to have a management fee of some kind, mostly between like 20 basis points and 50 basis points from what I've seen so far. Um, so yeah, for what it's worth, Bitcoin ETFs are now a thing. You can buy Bitcoin in your IRA. With ease, which didn't used to be possible. So I do think that this will become a core allocation for us in at least our capital strategy, maybe even in the low volatility strategy, despite the fact that Bitcoin is extremely volatile still. Um, it's a store of value. It's digital gold, right? It's hard money. It has all the same characteristics that has made money has made gold currency for several thousand years, maybe since the beginning of time.
Yep.
And so, for that reason alone, I do think that Bitcoin will be around for the long haul. And I think you want to make it a core allocation. I don't think we'll make it more than a 2 or 3% allocation in any of our strategies, right? It's ideally, it's going to just maintain its purchasing power over time. But I still do think there's plenty of upside. I'm not saying this will happen, by the way, so don't don't quote me that I said, oh, this is what it's going to be worth. But I'll say it this way: I will not be surprised if Bitcoin trades at 200,000 per coin in the next 5 years, maybe even in the next couple of years. Currently at around 40,000 today, down from about 49,000 the day before these ETFs got approved, which was like January 11th, so not that long ago. So, take that information for what it's worth, which is nothing. And if you want to buy some Bitcoin in your IRA, you can easily do that. Just dial up one of these ticker symbols.
Yep.
IBIT is the BlackRock one. Probably will end up being the most popular, biggest one. But FBTC from Fidelity will probably get some assets as well. Wisdom Tree is another popular one. ARK even has one of their own funds. ARKB is the symbol. So there you
Yep.
go.
It's a number of ways to get in. So,
Yep.
and then one last slide here, and I apologize. I probably should have had this in a little different order and included this with some of our, fundamentals in the economy. But, the big one here, we've talked about this so much, the inversion of the yield curve. And it came to my attention that we are 2 weeks away from, if it continues to be inverted, which it certainly looks like it will be the longest inversion in recorded history, which this tends to be the best predictor of a recession. And I have to say, I'm no economist, but it alarms me a little, scares me to think if this is the longest it's been inverted and that's the indicator, what's the fallout? So doesn't mean that we're tanking this year. Uh, who knows? We may never tank, but it is something to look at, and it's hard not to start to think how this is going to kind of feed through the economy.
Yeah. No, I'm tired of looking at it. I can't wait to stop looking at it, man. Holy smokes, been watching this thing for years and just hasn't reverted. And when it does revert, that'll mean that very highly likelihood that a recession is about to begin because that's what's happened every other time is that, it went from negative to positive and then a recession started. Negative to positive and a recession started. Negative to positive and a recession started over and over and over and over again, um, since we've been keeping track. So That's what usually happens. I'm not one to usually say this time it's different because those words are too dangerous for my liking. Um, so this time's probably similar. It just that's the way it works.
Yep.
So what kind of time we at? We had an hour yet?
We are at 46 minutes right now.
All right, so I got one last thing that I want to talk about with you before we go. Unless did you have anything else on this the
That is it.
yield curve deal? So what what I'm curious about is kind of just, what's the consensus thinking today? Because the consensus is usually not, I mean, again, not always, but going back through history, if the consensus is like very clear, everybody thinks that this is going to happen, whatever this is. Usually it doesn't, right? So I'm trying to get at what is the consensus? What is the main consensus thing or things right now? Like if you asked everybody in the market, what would they all agree on? Do you have any
I
things that jump out
if
at you?
Yeah, so I know one is if we're predicting the economy, is I think every economist out there is predicting a recession. Um, Oddly enough, they predicted one last year too. So that's a big one. Um, in terms of targets, so where's the S&P gonna end up? Oddly enough, now there's definitely it's I think like an up 10% year is what they're predicting. And it's funny because most of those, market predictors also got last year wrong. They all said we're tanking, and so we'll see. But yeah, I'm definitely seeing that a consensus is, a moderately upward year, and then a recession is definitely in the cards if I listen to all those economists.
Hmm. So I would say the opposite, to be honest. I haven't heard anybody call for a recession this year. Last year, I think that was definitely the consensus as we headed into 2023, is everybody said that there would be a recession due to all the Fed hiking in 2023. But so maybe this isn't a consensus view if that's what you're seeing from the reading you're doing, but everything I see lately has just been soft landing, inflation's done, there's no indication there's going to be a recession. GDP came out today at 3.3% instead of 2%. Like I don't see anybody really calling for a recession at this point. All the people who were calling for a recession last year have kind of turned and now say they expect kind of a soft landing is the big, we went over
Yeah,
that chart, right, where the soft landing is being searched for at higher rates than ever. So I would say consensus right now, from my studies, is that soft landing, not recession.
I would, and that is 100% accurate. Soft landing, I've heard that term so many times.
Yeah.
And that is one of those where when you think of what the consensus is and wanting to fade that, because usually that's how you make money in the markets. If that many people think there is a soft landing in the cards, it that scares me. I would almost prefer everybody's terrified.
Well,
And
that's exactly last year, right?
yeah,
So and what about as consensus what the Fed's gonna do?
oh, they're cutting rates. What is it? Three different rate cuts are implied in the market.
Yep. I would say that's definitely a consensus view, is that the Fed is going to cut rates. And that's probably a consensus view because the consensus view on inflation is that, what would you say? What's the consensus on inflation?
Oh, it's coming down.
Yeah, it's
It's
it's done,
Don't worry
right?
about it.
It's game over. We already won that battle. Inflation's not a big deal anymore. Um, so yeah, that's what I kind of think. I mean, and I got some of this from Howard Marks, reading Howard Marks' recent thing. He said, 18 months ago, it was nearly universally accepted that the Fed's aggressive rate hikes were going to result in a recession during 2023. And the truth is I was in that consensus camp. I believe I didn't see any way that wouldn't happen. Honestly, like I couldn't believe it. And
Right.
then came the government spending untold amounts of money and borrowing untold amounts of, like, just I didn't see that happening. Like I didn't think that would I didn't think they would do that. I didn't think I certainly didn't think that banks would fail and people wouldn't care. Like, I don't know. So I was in that camp. I thought for sure there'd be a recession in 2023. And I got it wrong. Just like
Yeah.
everybody else did. We got it wrong. We're all
Yeah.
wrong.
And one thing that I think is very important to hit on, and this is one of those Mark Douglas market psychology items, but you have to remember one thing. Whatever stock or commodity, whatever you're trading, it is worth whatever somebody is willing to pay for it. So,
Mhm.
I mean, we could have the deepest recession in theory, and if somebody's willing to pay, you know, SPY and buy it at 5,000, well, then it could trade up there. So I think it's just so important to always remember that. Now there's other factors underneath moving that, but that is how you get these dislocations in the market is that somewhere out there, there's enough people with money that are willing to buy when everyone else is selling, and it might be outside the range of expectations.
Yeah. Well, as we're talking, Janet Yellen is speaking and she says inflation is coming well under control. She says that debt service costs are still quite manageable. She also says that, and I can't even believe she says that Bidenomics investments will pay off in growth. Uh, Bidenomics is what causes inflation, lady.
Yep.
I don't know. She's smoking crack. Anyway, but so just more ammo for those being consensus views. But in October of 2022, like the low of the bear market, um, the optimists, who were buying stocks and kind of kicked off the rally we've seen since then, were motivated by their belief that the Fed would pivot and start cutting rates in 2023. So that was a consensus view, right? The Fed would have to
Hmm.
cut rates in 2023. That was wrong. Consensus was wrong again. Everybody was sure the Fed was going to cut rates. I was against that one. Thankfully, I got that right. They did not cut rates, but the market rallied anyway, just on the hopes that they would.
Right.
Um, yeah, and then, just before the end of the year, like midway through the year in 2023, say, call it June or July, the consensus was that there would be one more rate hike in 2023. And they were wrong about that too. So the consensus is often wrong, even if you can't believe it. And I think today the consensus is that inflation is moving in the right direction, and it's 2%. It's basically the inflation battle is won. The consensus is that there won't be any more rate hikes. The consensus is that there will be a soft landing. We'll avoid a recession. The consensus is that because we'll avoid a recession, or maybe because of this we'll avoid a recession, is that the Fed is going to cut rates, and the consensus is that overall that will be good for stock market. But those are all consensus views, and if all the consensus views from last year turned out to be wrong, I wouldn't be surprised if all the consensus views from this year turned out to be wrong,
Yep.
because the market likes to do what hurts the most people the most,
Yep.
and so.
And I'm with you there.
So anyway, that's just what I keep thinking about, and so yeah, I learned a lot last year, but one of the things was I need to be a little bit more freaked out when I agree with the consensus. Like I need to go out and look for reasons and say like, well, how could I be wrong? Like, because when you're with the herd, it kind of feels good, it feels comfortable. But the herd is often being led to slaughter, and you want to get the heck away from that when that's the case. So.
Yep. And this is something, best book you can ever read, Reminiscence of a Stock Operator. Go back and it's the oldest tale in the book is you have companies come out, publish positive reports when they're trying to get the stock to come up. You'll also have the opposite side where, everybody's trying to buy cheaper. So why not throw out some nice recessionary articles and push the market lower? So hard to believe the headlines, but that consensus view does come through, and it's very important to ask if that is the side to be on, because being the contrarian can definitely pay off.
Yeah, and one other thing I would say to read is if you go out to our website and hover over the menu, you'll find one called resources, and below resources, there's a reading list. If you click on that reading list and scroll down a little bit, you'll find a link to the memos from Howard Marks. And reading the most recent one of those, which is from January 9th, is when it got released, it looks like, to the public. That's you can actually listen to it as well. There's a podcast link on there, but I would read that. I read it last night, and that's where I kind of got that all these ideas about consensus versus non-consensus thinking, and just I'll write about that a little bit more and put a link in my commentary. So if you're not subscribed to our market commentary, you can subscribe to that too, and you'll get a link to it when I write my next one, which I think will be February 9th. Friday, February 9th. So anyway, Kyle, good
So
catching up with you, man. Sorry to waste everybody's time. Hopefully it was good content and worthwhile.
I think so. So, thanks everyone for tuning in. Please like, subscribe, leave some comments too. Just like to kind of hear what you're thinking, if there's any topics that we can hit on. So with that, I'll let you go. And Shane, thanks for taking the time.
Thanks, man. Have a good one.
You too. Bye.